Budgeting is a very, very important part of running a business, isn't it, Andrew?
It is. Obviously, a budget is a plan or an estimate of what our expenses might be and what our income might be. So it's important that we identify all the different expenses that we might incur during a month, as well as all the income streams that we might be able to experience. But budgets come in different forms. We've got to recognise that we're doing it over different periods, and that might vary. The budget might vary to what we call our cash flow budget. So a visual example might help us here.
100%. It's really, really important for a business owner to understand the importance of the difference of budget and then what happens on a cash basis as well. Okay. So let's have a look. So Andrew, we've got one budget here and then two actuals. So basically what we're looking at is February. In a real estate company. We're looking at what we budgeted for in that particular month. So we're pretending as though maybe we're a little bit down the track, maybe we're 6 months or 12 months into this business, and we've got a healthy rent roll, to be honest. So we're looking at management's around what?
125?
125 roughly. So income we've predicted to be around that 16,000 mark. Yep. Now in that month, we're hoping to have made, let's say, 3 to 4 sales. So anywhere up to that 60,000 mark. So we've got a total of what the income side of things, of what we expect to bring in on that month. Now, obviously, it's a little bit, I suppose, minimalistic.
It's an estimate. It's not in cement, it's an estimate, it's a guide of what we want to achieve. That's what a budget is.
That's right. And certainly on the expense sizes, we haven't listed every single expense we expect, so we're doing a bit of a minimalistic budget, but it's going to still paint that picture. So from all of these expenses that we have, and we might have a figure related to them, but overall, we think it'll cost the business $60,000 for that month to run. And obviously we know one of the biggest expenses in any business is the wages bill. So that's one of the most important things. But then therefore we've estimated our net profit to be $16,000. That's what we've thought.
There's a 20% return on your investment. So we're thinking that's approximately the business model that we're building.
Yep, and that's healthy. I mean, if we add that as a plan, that's in a really good, reasonably good condition. Now let's look at the actual side of things. So when you monitor business performance, it's really important to compare what you thought or what you'd planned to what had actually happened. So in February, our property management commission obviously stayed the same, but we didn't make that extra sale we had planned. Okay, so our income fell slightly, so to 48,000. So our total income for the February was 64,000. Our expenses didn't change in that month; they were stayed fixed. So we made a net profit of 4,000. It's profit, but not what we'd, I suppose, thought.
It's not a tragedy, but if you look and say, okay, maybe our listings was down a little bit in January, being the start of the year. A lot of agents are maybe on holidays at that time, so it's not something worth panicking about straight away.
No, I agree. I mean, particularly because, as I said, we're still in the black here, so we're not losing money. Now let's look on a cash basis. So this is the really, really important part to, I suppose, look at, because even though maybe sales had come in this month, from an exchange point of view, they weren't necessarily settled. So we didn't see the income, until maybe the next month or even the month after, depending on the settlement period. So what we're actually looking at from a sales point of view isn't the February. Most likely it's going to be January,
December,
or December. Hence the reason why, on a cash basis, of the actual money that's come into the business, it has dipped significantly. So what we can see is the total income for the month was $28,000, significantly down, from what we'd planned and what had actually happened. Expenses, I mean, we've put in here that there was maybe an expense there from a cash point of view. Maybe our tax bill came in that was a little less favourable than what we thought. And the income, or the expenses, I should say, went up slightly from 60 to 70,000.
Totally believable situation.
Exactly right, certainly realistic. So therefore, now what we have is our expenses greater than our income, which is why we put these in brackets, which is a negative. So we now have a net loss of $42,000.
Quite different to our projected budget, which gave us a $16,000 profit.
Exactly right. So as a business owner or as a business operator, understanding the difference between these three is really important, because now what you'd also have is not only just a budget, but you might have a cash budget as well. So you can now, if you had known you'd had a cash budget, or say you could predict that income decrease in the month, you could create a plan to cover the net loss for that month, and that would be the way you would obviously keep the business running.
That's a good budgeting model.
So it's important that we understand the difference between the two, and hopefully that helps everyone at home, particularly when you're answering the questions about finance.